Hey everybody, welcome back to Gold Rush Reporter, where we dig deep into the truth behind silver, gold, and the real value of money. I'm your host and silver analyst, bringing you another powerful breakdown of what's really happening in the precious metals world. So here's the question we're tackling today. Is silver truly cheap? And how high could it actually go? It's a topic that gets silver stackers talking all the time, especially when you see the spot price sitting under $20 an ounce. But is that price a bargain? Or a warning sign that the market's being held down? Let's find out. Before we jump in, make sure you hit that like button if you appreciate honest data-backed analysis. And don't forget to subscribe so you don't miss future updates on gold, silver, and the coming shift in our financial system. All right, let's start with the basics. By almost any historical measure, silver is ridiculously undervalued right now. If you take its 1980 all-time high of $50 per ounce and adjust for inflation, even using the government's conservative CPI numbers, that price comes out to around $179.78 per ounce today. That means, on an inflation-adjusted basis, silver is trading at barely 1/9 of its historic high. Now sure, that $50 mark was a spike, not a long-term average. But even if we adjust for the lowest levels after that crash in 1980, silver still looks underpriced. When it fell to $10.89 back then, inflation adjusted, that would be $39.16 today, nearly double the current price. So the data clearly shows that silver's current value doesn't match its historic potential. But let's take it one step further, because numbers alone don't tell the full story. One of the most powerful indicators we use in this market is the gold to silver ratio. Right now, as I record this analysis, the ratio sits around 91, meaning it takes 91 ounces of silver to equal 1 ounce of gold. Historically, that's near the very top of the range. And that's important because this ratio tends to collapse during bull markets, when silver begins to outperform gold. For example, during major precious metals runs, this ratio dropped to 35 in 2011 and even as low as 15 in 1980. When that happens, silver doesn't just rise, it explodes in value compared to gold. And if you look back even further in US history, the Coinage Act of 1792 actually fixed this ratio at 15:1, a reflection of how the two metals were valued in a hard money system. Interestingly, the mining ratio today, the amount of silver mined compared to gold, is closer to 9:1. So, we're producing 9 ounces of silver for every 1 ounce of gold. Yet the market values gold 90 times higher. That's a massive disconnect. And it's one that won't stay this extreme forever. On top of that, most of the silver ever mined has already been consumed by industry, used in electronics, solar panels, medical tech, and other applications. Meanwhile, almost all the gold ever mined still exists in vaults and jewelry. That means silver's supply is actually shrinking in real terms, while demand keeps growing. If the market ever re-rates silver to reflect this imbalance, even with gold prices staying stable, the potential upside is huge. Just imagine this. If gold were to stay at 1,170 an ounce and silver traded based on its natural 9:1 mining ratio, then silver's fair value would be around 196 per ounce. That's nearly a 10-fold increase from today's price. So yes, by every measurable standard, silver is cheap. But the bigger question is, why? Why does such a valuable industrial and monetary metal remain so undervalued in the face of global debt, inflation, and currency debasement? That's what we'll start exploring in part 2, where we'll break down the deeper fundamentals behind silver's suppressed price, including money supply expansion, real inflation rates, and how fiat currency creation has completely distorted true metal value. let's dig deeper into what's really keeping silver prices so low, and why that might be setting the stage for one of the biggest upward revaluations in decades. One of the most eye-opening ways to understand silver's true value is by comparing it to the money supply. If you go back to 1913, the year the Federal Reserve was created, the US Geological Survey and the Fed's own data show that for every ounce of silver mined, about $2.66 new dollars were created. At that time, silver was worth 0.60 per ounce, which was roughly 22.5% of the dollar creation rate. Now, fast forward to today. For every single ounce of silver mined, around 2,400 new dollars are created. If silver's price had simply kept pace with that ratio, just like it did in 1913, then silver today would be worth around 316 per ounce. That's a shocking difference. It tells us that silver hasn't just been undervalued. It's been systematically left behind, as fiat money has exploded in supply. In other words, the silver market has not reflected the massive inflation that's been quietly eating away at purchasing power for more than a century. And it's not just about how much money is printed. It's also about how much silver is actually available. Silver has a dual nature. It's both a monetary metal and a critical industrial commodity. Unlike gold, which mostly sits in vaults and jewelry boxes, silver is used up in manufacturing. It's in your smartphone, your car, your solar panels, and even your medical devices. Much of it can't be recovered cost effectively. That means we're literally consuming silver faster than we can replace it. So when we talk about silver being cheap, it's not just undervalued, it's scarce. And scarcity is what eventually drives prices higher. Let's take this a step further. Imagine for a moment that the world tried to return to a gold-backed currency system. The US M2 money supply is now above 21.6 trillion, according to the latest Federal Reserve numbers. The US Treasury claims to hold around 261 million troy ounces of gold in reserve. If that gold were to fully back the dollar supply, each ounce would need to be worth roughly 82,800. That's not a prediction, that's just the math. Now, if the gold to silver ratio remained at the current level of 91, that would imply a silver price of about $910 per ounce. Now maybe that sounds extreme, but keep in mind, these figures are based purely on existing supply and currency volume. The higher the money supply grows, the more this gap widens. And even if we never return to a formal gold or silver standard, the underlying pressure remains the same. Every time the Fed prints money or cuts interest rates, it erodes the real value of the dollar and increases the value of finite hard assets like silver. That's exactly why long-term silver stackers aren't worried about short-term price dips. They understand what's happening behind the scenes, a massive disconnect between physical reality and paper money illusion. Just look at what happened during the 1970s. The US abandoned the gold standard in 1971, and silver was around $1.55 per ounce. Less than a decade later, in 1980, it peaked at $50 per ounce, a 3,200% increase. That's not speculation. That's history repeating itself whenever confidence in paper money collapses. If silver experienced a similar percentage gain from its 2020 low of $12 per ounce, we'd be looking at a future price of around $384 per ounce, a level entirely consistent with historic performance under high inflation conditions. So, what does that tell us? That silver isn't just undervalued, it's positioned for explosive growth. Once inflation, debt, and fiat instability start colliding again, And all the signs suggest we're heading right into that zone. Now let's take a closer look at what's really driving this setup for silver. Because when you connect the dots between government debt, inflation, and central bank policy, you can clearly see why the next major move for silver might be far stronger than anything we've seen before. Let's start with government debt. The US national debt is now over $35 trillion and still climbing fast. Every single second, the government is borrowing more money just to pay interest on what it already owes. That means the US is now in a stage where it must either print more dollars or default. And we both know they're never going to choose default. They'll print. And every time they print, the value of existing dollars drops. You might not see it overnight, but you feel it. In higher food prices, rising rent, and shrinking savings power. This is hidden inflation, and it's the silent destroyer of wealth. But for metals like silver, inflation is fuel. Because silver isn't something you can print or create digitally. It's a finite resource, and it has real, tangible value. That's why, during times of currency instability, people and institutions shift their money toward hard assets. Silver becomes a form of protection, not speculation. Now add the second factor, inflation pressure. Official inflation numbers might suggest prices are under control, but we all know real-world inflation is higher than what's reported. And the central banks know it too. That's why, behind the scenes, they've been buying gold and cutting dollar exposure at record rates. But here's the thing. While gold gets all the attention, silver often follows late and then moves faster. Historically, silver lags behind gold at the beginning of a bull cycle, but when the move starts, it outperforms gold dramatically. That's because silver's market is much smaller and easier to move with less capital. When the big money flows in, it creates explosive momentum. The third element in this chain is central bank policy. Over the past few years, the Federal Reserve has tried to fight inflation with aggressive interest rate hikes. But higher rates come with a cost. They increase the burden of government debt. That's why many analysts now believe the Fed will soon be forced to pivot, either by cutting rates or by launching some form of quantitative easing 2.0. And when that happens, it will likely trigger a new wave of dollar weakness. That's when silver historically shines. Think back to 2008 to 2011. During the global financial crisis, silver shot up from around $9 to nearly $50 per ounce in just 3 years. Why? Because the Fed printed trillions to bail out the system, and investors ran straight to hard assets. The same setup is forming again right now. The debt is higher, the money supply is larger, and the trust in fiat systems is weaker. Every signal points toward another cycle of monetary easing. And when that begins, silver will react faster than most expect. But it's not just macroeconomics. There's also a supply crisis building beneath the surface. Major mining companies are warning about declining ore grades, and new discoveries are rare. Global silver production has been flat or falling for several years, even as industrial demand from solar panels, electric vehicles, and electronics continues to rise. That means we're entering a phase where demand is climbing while supply can't keep up. A perfect storm for higher prices. To put it simply, debt keeps rising, inflation keeps eating away at value, and central banks keep losing credibility. All of that leads to one outcome, a global pivot back to real money. And when that shift happens, silver will be one of the biggest beneficiaries. Now that we've covered the monetary and macroeconomic side of silver, let's focus on the industrial engine that's quietly pushing silver toward a potential supply crunch. Because while most investors think of silver only as a precious metal. In reality, more than 50% of global silver demand now comes from industrial use, and that's where things get really interesting. Let's start with the green energy revolution. Every country is racing to meet carbon reduction targets, and that means more solar panels, electric vehicles, EVs, and battery technologies. Each of these industries relies heavily on silver. In solar panels alone, silver is used in the conductive paste that allows electricity to flow efficiently. It's not just a small amount either. Every gigawatt of solar capacity requires roughly 80,000 ounces of silver. According to the International Energy Agency, global solar capacity is expected to triple by 2030. That means solar alone could consume over 300 million ounces of silver annually, which is nearly the entire current global mine supply. And that's before we even factor in EVs. An average electric vehicle contains up to 55 grams of silver, nearly twice what's used in a conventional gas-powered car. With EV adoption accelerating, we're heading into a world where cars, trucks, buses, and even charging infrastructure will require more silver than ever before. Then there's electronics, smartphones, computers, medical devices, and communication systems all rely on silver for its unmatched conductivity and resistance to corrosion. There's simply no substitute that performs as well at the same cost. Even if manufacturers try to reduce silver use per unit, the explosion in total devices means total demand still rises. Now, combine that industrial demand with the limited mining supply, and you start to see the problem. The world currently mines around 830 million ounces of silver per year. But global demand has already exceeded 1.2 billion ounces. That's a deficit of nearly 400 million ounces annually, according to data from the Silver Institute. This shortfall has been covered by recycling and above-ground stocks, but those reserves are drying up fast. Once that cushion is gone, the market will have to reprice silver upward to balance supply and demand. And that's when prices can spike dramatically, sometimes within months. Even miners are struggling to keep up. The average silver grade per ton of ore has been falling steadily for years. It's taking more rock, more energy, and more cost to produce the same ounce of silver. Many major mines are focusing on gold, copper, or zinc, where margins are better. That means silver is becoming more of a byproduct metal, not a primary one, further tightening supply. And here's where it gets even more critical. The renewable energy transition depends on silver in a way that can't easily be replaced. If silver becomes scarce or too expensive, the cost of producing solar panels and EVs could skyrocket. That's why some analysts call silver the Achilles heel of the green economy. Meanwhile, countries like China are aggressively stockpiling silver to secure their industrial needs. Reports suggest Chinese refiners have been importing massive amounts of silver over the past year, while Western investors are still distracted by short-term price fluctuations. This creates a situation where East and West are moving in opposite directions, one accumulating, the other ignoring. And that's usually how big turning points begin. When the physical market tightens, paper trading and manipulation can only hold back the price for so long. Eventually, the imbalance forces a correction. And when that happens, it's not gradual, it's explosive. So, to sum up, silver isn't just a hedge against inflation, it's the foundation of modern technology and the future of clean energy. With demand accelerating and supply struggling, it's only a matter of time before the market wakes up to reality. When you put all the pieces together, the monetary side, the industrial side, and the global economic backdrop, it becomes clear that silver is standing at the edge of a historic turning point. Let's recap what we've uncovered. First, the monetary foundation. Global debt is spiraling, fiat currencies are losing purchasing power, and central banks are quietly repositioning toward hard assets. Inflation, whether admitted or not, is permanently embedded in the system. And history shows that when confidence in paper money weakens, precious metals, especially silver, surge in value. Second, the industrial foundation. Silver isn't just a shiny metal sitting in a vault. It's the backbone of the modern world. Every EV, every solar panel, every smartphone, they all rely on it. As the global economy transitions toward renewable energy and electrification, the demand for silver will explode. Meanwhile, supply is tightening year after year. That imbalance alone is enough to ignite a powerful upward move in price. Third, the global shift in control. Nations like China, India, and Russia are quietly increasing their holdings in real assets. They understand what's coming. A financial reset that rewards tangible value over printed promises. While Western markets still debate whether silver is just another commodity, the East is accumulating it strategically, preparing for the next monetary era. So where does that leave us? It leaves us in a moment of opportunity, a window where silver remains undervalued, underowned, and underappreciated. Most investors are still focused on digital trends or short-term stock movements, unaware that a 100-year cycle is about to turn. That's all for today's breakdown. If you found this analysis helpful, don't forget to hit that like button, subscribe, and ring the bell so you don't miss the next update. Here on Gold Rush Reporter, we cut through the noise to bring you clear, data-driven insights on gold, silver, and the changing world economy from a specialist's perspective. I'm your host, your silver analyst. Thanks for watching, and until next time, keep stacking smart, stay informed, and always follow the rush, the gold rush.